There's a lot of concern today on how in the hell did the market go so high up over the past decade, what makes it do that, and why it's bouncing so fast back up from these market losses. And to do that, we're going to explain one of the reasons, which is what is a stock buyback, what makes it work, and what is a stock in general. How does the stock market work? Well, I don't know. Goodbye, sir. Bye, goodbye, goodbye, bye. Sell them all. That man is gonna sell them all. Well, I'm gonna buy them all. This is going to be somewhat of an opinion piece because my personal opinion is that in general, buybacks are bad. Not necessarily good for the economy, especially if you're taking on debt in order to purchase and do the buybacks. There's two perspectives on what a stock is. You have two people in the room and they try to find out the value of something. Like tulips, you can go up all day and have the tulip be worth $1 million, but once you get outside there, a person may only pay like $1 or something for a tulip. It's the perceived value of something that makes it worth what it's worth. So when you're talking about stocks, you're talking about the assets and the perceived value. The perceived value is the one that's important here. Now, a company can be worth more than its assets in the stock market because there's an intrinsic value that is placed upon it when you put it in the stock market. It could be worth $1 trillion more than what actually is asset to, because how can you put a price on Apple? How can you put a price on what they put in your head and their perceived value of how much they're worth? It's a very, very tricky thing to do. That's why something like Tesla is worth almost 1,000 with a market cap value bigger than Toyota when they make significantly less cars. The reverse can also be true. You can have a company like, say for instance, GameStop, where all their assets are worth more than the company itself. So in theory, you could sell it all and still make a profit because the perceived value of GameStop is much lower than its actual asset value. So people will say that it's going to go up belly under, it's going to not do so well. So you're just selling for scraps, basically, like a cigar butt stock, as Warren Buffett would call this. Now you're probably thinking, wait, this thing can be misvalued. This whole thing can be undervalued. This whole company I can buy for cheap. Well, yes, that's why you buy stocks. You're trying to buy it low and trying to let it go up over a long term. Another factor that comes into play is supply and demand. So if there is a bunch of stocks available and very little demand, there is going to be a drop in value. So if, say, like over 50% of the company was available to buy, and there were just so many shares, but only like 5-10 people wanted to buy it, that would significantly reduce the price. Hence, this is where a buyback comes in. If you just reduce the amount of stocks available by buying them back into the company, when the value is lower than what you think it is, then when you buy back, that gives more money to the shareholders, it raises the price up, and it seems like it's good for everyone, right? Well, not so fast there. It does not do it permanently, as a company has not really done anything when they just do a buyback. They're just buying with excess cash, or worse, they're buying with a bunch of debt and they're putting yourself into more debt, buying back shares when they don't need to, they can't afford it, and the money would be much better spent increasing the wages for workers, increasing innovation. Now, there is a single argument where if you are a company, you're probably not going to increase the wages on a mass scale for everyone just because, unless there is a legal reason to do so. Like, say, if you had to raise the minimum wage to $15 an hour, you would have to cut back employees, or maybe they offer a tax incentive to hire more or manage the same amount, but just increase the wages. But either way, there has to be some sort of incentive. There has to be a reason. Why am I paying you more for this value that when you're doing the exact same amount of work? Back in terms of buybacks themselves, there's definitely some benefits, and there's definitely people who have been able to do it to their benefit. I'm not saying it's morally right, but they have done it to where it seems to benefit them. Say Apple, for instance, their price has been going up and up and up, and while other people have gone bankrupt, they have lost a significant amount of value by buying back stocks, taking on debt when it's an unnecessary thing to do. There is a right and a wrong way to do it. Apple has split their stocks several different ways, several different times, but they can do it because their amount of cash reserve is so significant that they can afford to buy back shares of their own company, especially because they feel it's undervalued, giving more confidence to shareholders, and they still get so much revenue, it barely matters to them anyway, for the most part. Now, long term, who knows how this is going to pan out for them at the very least. Who knows how this is going to pan out for other companies that have been doing successful buybacks. Now, if you want to benefit shareholders, give them a higher dividend. So a dividend is free money. You get money for owning a stock. If you own one share of Apple, you get about 78 cents as of this moment. And it's just money to show that they're growing consistently, and there's proven track record that they can afford to give you money, and they have that luxury of doing so. Therefore, you know that it's a company that's probably going to keep on growing in the long term if they can afford something like dividends. Now, if you want to benefit shareholders, give them a higher dividend. It will benefit you too if you own shares of the company. It makes sense, right? If you have nothing else to do, then just raise the dividend or start giving off dividends. It is the solution, in my opinion. Buybacks are something that have gotten companies into a lot of trouble, like Delta Airlines or pretty much any airline, because they run on fumes and go into debt, buying stocks of their own company that they cannot necessarily afford, especially when things go bad. It's just an accident or one giant fall waiting to happen. Think about innovation. Think about just paying more dividends. Think about just holding cash just in case of an emergency. You always could use an emergency fund in case something like this market crash happened back in March. There is one bright side to this. That is excess cash. You're going to have excess cash and you have nothing else to do with it. While I would say raise the dividends, and while I personally don't believe that it is the right thing to do, it does benefit some people if you have nothing else to invest in, especially in the case of Apple. As long as you are not going in debt, you should be okay. As long as you are buying undervalued, you should be okay. There are definitely cases where you can get greedy with this though, because over $1.2 trillion have been spent in buybacks in just 1 year alone in 2018. That is insane. You could literally spend it on anything else. You can spend it on a tax write-off, helping some worthy charity or anything, rather than just giving money back to the investors. And usually happens, it ends up back to the owners and the insider shareholders, which is not right. In my personal opinion, that's my values, that's my beliefs. What do you guys think? Let me know in the comments, like and subscribe. Now, this definitely isn't the only reason why the whole stock market is going up, but it is a dang significant reason why the market just keeps going up and up and up.